Hello, everyone, and welcome to Fundamental Auditing, Chapter 1. So this video is going to go through the more, important topics, or just topics that I wanted to highlight for this chapter. So when we're going through when I'm doing the lecture for all the chapters, I'm just going to go through just some points I want to highlight and discuss, because maybe they're a little bit more complicated to understand just reading the textbook, or just something that I want to clarify or add to or something. So you do have to go through all the material, but I just want to highlight the more important topics in these videos. Okay, so chapter 1 is just giving us an introduction to auditing, figuring out what auditing is, kind of getting your feet wet with it. Okay. So basically, auditing is the verification of information by somebody other than the one providing that information. So management creates the financial statements, and then an auditor is going to look at the financial statements to see if, to verify that the information is correct. So that's basically the definition of auditing. So management creates financial statements. Sometimes those financial statements need to be looked at or reviewed by an independent person, which is an auditor, because maybe some outside person wants to, so either a user of these financial statements, it could be a creditor, so somebody wants to lend money to the company, but they want to make sure the financial information provided by management is correct, or somebody wants to invest in the company, so maybe a shareholder, investor, they want to make sure that the information is correct before they invest, because management can just put any information, financial information, on the financial statements. We need audits done in order to make sure to vet the information, or somebody independent looking at the information to make sure it's correct. So when you're doing accounting attempts to record and summarize a company's transactions into financial statements, so users of the financial statements can view them, but an auditor acts as an independent party that comes and verifies the information. So then the users of the financial statements can be shown that, okay, somebody did look at this and gave it an outside view, so they'll just have more comfort over the numbers. Okay. So there's basically kind of three parties that are interested in the information. So there's the users. So the users can be the public, the investors and creditors, employees, customers, lots of different users of these financial statements. The accountable party is the management. So management is accountable to the users. So they're accountable of giving financial information to the users. The auditor is also looking at or participating in the view of providing information to the user. So the auditor is kind of acting in the best interest of the user, not really the accountable party. So the accountable party, management, or the company, they're the ones that hire the auditor, but the auditor is really there to serve the users, to make sure the information is appropriate for the users to make decisions on the financial statements. So that's what external auditing, that's basically what I've been talking about, is an external audit. So the external auditor is independent from management. They don't produce or help produce the financial information. They're very independent and they just review the information. So the auditee is the organization whose financial information is being audited. The client is the person who hires the auditor and pays the fee. Usually the client and the auditee are the same when it's just a corporation or organization that wants the audit because the bank is asking for an audit. So your client will be the corporation, the auditee would also be the corporation. Times when this is different is when maybe there's a parent company, and the parent company is the client who hires the auditor and pays the fee, and then the subsidiary companies are the auditee, the organization whose financial statements is being audited. So the objective of the auditor here is to prepare an opinion on whether the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. So they want to check if the financial statements are in accordance with either IFRS or ASPE. So they're going to look through the IFRS and ASPE rules, find out if the company is following the policies to record their transactions, either with IFRS or ASPE, whatever they're using. When we audit, we need to use our professional judgment. So auditors will need to use their professional judgment, which they get from training, their knowledge, their experience, to make decisions of the audit. So if a policy can go one way or go another way, you use your professional judgment. So there's some things where there's no like proper right or wrong answer. It's the way that we interpret the IFRS and ASPE rules. So auditors have to use their professional judgment in order to see if the actions of management when they're creating the financial statements are appropriate. Auditors also have to use professional skepticism. This is the auditor's tendency not to believe just what management is saying, but to actually find appropriate evidence to prove what management is saying. So if management's just making a claim that, this number is correct because of so-and-so, because I approved it, or because there's 3 people looking at it, reviewing it, that's not enough. You can't just listen to what management is saying. You have to get support or get evidence to prove that. So you're always kind of skeptical about what management is saying. So you have to do that extra step to actually get the evidence. There is an expectation gap in auditing, which kind of have to just keep in mind, which is basically the difference in what the expectations of the users are of the financial statements and the auditor's expectations in the financial statements. So, for example, from this is what users think is that the financial statements, if they're audited, then they're 100% correct. So sometimes that's what this is like one of the examples of the expectation gap. But however, when you're auditing a company and auditing their financial statements, you are not auditing every single number or every single transaction to see if every single transaction is correct. You're taking basically a sample of numbers, like for revenue, for example. If revenue is $1 million, but there's so many different transactions, you're not looking at every single transaction to determine whether revenue is actually $1 million. You're looking at maybe a few of the bigger transactions. Okay? So maybe you're not looking at all the little tiny dollar amounts, but you're looking at the more bigger, substantial dollar amounts to determine if the revenue number is reasonable. So not 100% correct, but reasonable. There's a few definitions that I just want to go through in this first chapter, because these will come up over and over again. So I just want to make sure that is understood here. Okay? So auditing, it kind of relates to reducing the risk that there are errors in the financial statements. Okay? So there are different types of risks. So business risk is the risk that the business has, conditions, events, or circumstances that the business has that would affect their ability to achieve their objectives and execute their strategies. So business risk is with the business, and as auditors, we need to determine what the business risk is for the client or for the people that we are auditing, to determine whether there would be any, I guess, motivation to manipulate the financial statements because of the risks that they have. We also have information risk. Information risk is the risk that the financial statements will not reflect the economic substance of the business activities. So it might not correctly, like for example, if the business had a going concern risk, the information risk is that, is that the financial statements won't show that going concern risk. So auditing tries to reduce the information risk to the users of the financial statements. So if financial statements have been audited, this will substantially reduce the information risk, because we'll gain some assurance that financial statements are reflecting the economic substance of the business. Audit risk is is when there is insufficient evidence gathered on the facts concerning the entity's economic circumstances. So here, audit risk means that the auditor didn't get sufficient audit evidence to come up with their conclusion on whether the financial statements are fairly represented or fairly presented. Accounting risk are risks that there's errors in the forecast used or the accounting estimates are not properly disclosed. So accounting risk, on the auditor also tries to bring down the accounting risk by looking through and reviewing the financial statements. All right, so now I'll just go through a few different types of audits. So external auditing that we looked at is when there's an independent third party that comes in and audits management's financial statements or company's financial statements. There's also something called internal auditing, and this is when like a department of your company does an audit or does internal audits. So they're similar to the function of an external auditor, but they're not separated from the company. Their salary is paid for by the company. It's just a different department that does internal auditing. So they don't have anything to do with creating the financial statements or the operations of the company. They just go in and review all the information, all the work. Sometimes an external auditor can rely on some of the internal auditor's work if they've done a little bit of work, but the internal auditor isn't 100% independent because they still work for the company. Another type of auditing is called operational auditing. Operational auditing doesn't look at the actual financial statements and whether they're correct or not. They look at whether they're efficiently using up their resources. Okay, so like maybe a government audit to determine if they're using their money appropriately, or are they using their money and effectively achieving their business objectives, or are they complying with companies' policies? So maybe HR has a lot of different policies, and an operational audit is used to determine if the policies are being adhered to. So there's not just an audit to audit the financial statements of the company to make sure the numbers are correct. There's all these different types of audits to determine is the company complying with some sort of rules or regulations. There's also public sector or government auditing. So kind of like what I said. So there's actually a few different ways that the government gets audited. They can get financial statement audits done. So whether their financial statements are presented fairly. So are their numbers correct or reasonable? There's compliance audits to determine whether an entity has complied with laws and regulations. So like I was saying, if there was any, well, we were talking about policies earlier, but if there's any environmental regulations, for example, that a company has to comply with, the compliance audit will make sure that they are complying with that. There's value for money audits, where an auditor will audit whether the government, if they got a bunch of money, are they spending it economically, efficiently, and effectively? So if the government gives, same with if the government gives funding to another, to a company or something, they just want to make sure that they're using that money effectively and efficiently. So they might do an audit for that. There's lots of value for money audits that the Auditor General does. So Auditor General of Ontario and Auditor General of Canada. So for example, they'll look at, they'll do an audit on LCBO, making sure that they're using their money effectively, or do an audit on the Go Transit or like Metrolinx, for example, stuff like that. And then there's regulatory audits. So CRA auditors, they audit individual and corporations' tax returns or taxes to find out if they're dealing with or adhering to the Income Tax Act when they're filing their tax returns. There's also federal and provincial bank examiners that come in and audit the banks to determine if if somebody is investing in the bank and giving their money to the bank to invest in. Are they getting their permission when they're investing in things? Are they investing in the right types of investments that the client has asked for, right? Or are they just taking their money and putting it in things that the client did not approve? All right, so then we have fraud auditing and forensic accounting. So looking at like an in-depth investigation of fraud isn't the primary responsibility of the external auditor. The external auditor looks at the financial statements as a whole, kind of make sure that they're reasonable. But when it comes to actually fraud of one party, so for example, if an employee is doing fraud, then they would hire like forensic accountants, which use their accounting or auditing skills in investigations involving any legal issues that there are. Fraud accounting is doing an in-depth investigation of a suspected fraud. So that's different from just doing an external audit on the financial statements. All right, so this chapter 1, just introduces auditing, what it is, kind of gets you to start thinking about what the different types of audits are. So it's not just a financial statement audit. There's other types of audits as well that a client can enlist an auditor's help with. All right, so thank you for listening and take care.